Hello and welcome to the Harwood Report for January 22nd, 2018, presented by Trade Academy. I am Keith Harwood, the founder of Trade Academy and your host for the Harwood Report. As always, we start with the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Consult with a financial professional before executing any trade. Please read through the rest of these disclosures. Make sure you are aware that none of this is considered a trade recommendation. This week's highlights, I really want to look a little bit closer at the equity market. So we've got a nice run up here. It's been pretty aggressive. And I don't hear a lot of people talking about the next leg higher. Everybody's talking about where to take profits and how much lower we can go from here once this bubble bursts. Well, that means that it's time for me to really focus on the option structures that I can use to capitalize on maybe some potential upside, because a lot of times the view that nobody is taking is the next move that the market takes. So I want to talk a little bit through how I'm looking at that. Bonds are interesting. They've had a good break last week. I had some puts. I rotated into puts and reds last week. And I still think there's some downside there, and I'll talk through why. Gold, interesting. Dollar yen's approaching an inflection point. Maybe this could turn the market there and really push gold lower, or we might just be prepping, setting up for the next leg higher in gold. And so I'll look a little bit about what's going on there. And finally, in oil. Oil continues to be strong. Earnings are coming out well from some of these oil names like Halliburton and Schlumberger. And OPEC is continuing their production cuts. So everything seems pretty supportive for oil. So I'll talk through a little bit of how I'm looking to play this going forward. First, let's start with fear and greed. It's at 79. It's basically at 80. That's that level that I get a little bit nervous. Doesn't mean it can't go higher. We got almost to 100 back a few months ago. It's, though, at a point where I need to be a little bit cautious. I need to be out on the lookout for signs of a pullback or consolidation. That doesn't mean we get a pull back to major pullback, 5 or 10%, but we could have a 2 to 3% pullback just to allow the market to digest some of the move that's happened. So speaking of which, let's first look at SPY. You can see that this has just been a beautiful, beautiful 3-week period here, really starting at the beginning of the year. It's just taken off through most of January with very few hiccups. And even with the government shutdown, the market is saying it really doesn't matter, which is kind of how my view has been as well, because the government's not going to stay shut down permanently. They're going to get a resolution. They're going to find a bipartisan deal. They're going to either extend the funding so that they can work through that bipartisan deal, or they will just find a longer-term solution. A longer-term solution is very bullish. A short-term solution allows the market to continue as it stands. So right now, the market continues higher. Just again, I'm looking for some of these moving averages to catch up before I want to get really aggressive with SPY, because SPY has been going so hard. It's really hard to chase this market when volatility is expensive. And speaking of which, I look at the VIX, and the VIX is starting to come down. This starts to give me a little bit more of an edge for how to construct a trade here. If vol comes down enough, I can start looking at calendars and expecting a sort of consolidation period that I mentioned. And if vol gets really cheap, then I can just play for some long outright options, knowing that I would expect the market to either take off for the next leg higher or get that pullback that I would then be looking at restructuring trades and everything else. So right now the VIX is a big driver for when I can get into the S&Ps. Right now it's a little bit tougher to do so. IWM has a little bit more interest to me because it has been pulling back fully to the 10-day moving average and finding great support there before taking off. And now we're pressing against the all-time high there, 159.41. If all these other markets continue higher, small caps are going to have to press higher, especially at the discount they are to the Qs right now. The Qs continue higher and are trading close to $9 over where IWM is. So a reminder, IWM right now is 158.65 and the Qs are over 167. Part of the reason that the Qs are having a good day today is biotech. There were some big acquisitions there. That's helping put some excitement into technology as a whole, not just biotech. Also, the semiconductors have had a very nice run over the last few weeks. And just so you can see the chart in biotech, a massive move in XBI today off of those takeovers. We had two big takeovers today, one in Juno and one in VIIV. Yeah, there we go. And those two, you can see that move. It went from 64 to 103. I mean, we're talking about massive premiums, and that's putting a lot of excitement into the biotech sector, recognizing that companies themselves are finding really good value in some of these names. So I now want to go in and actually look at a couple of trades I'm looking at, just because I think that's where the real value is here. First off, I'll look at the Qs. I note here that the vol is still pretty high, around 14%. It kind of peaks around 15.5. That doesn't mean that the vol can't go to 17 or 18. That's usually going to come out of pullback. I'm looking at the Qs for more of a grind higher mode here. There's still going to be some excitement about what's going on in biotech and semiconductors that I think could help here. But I think that once this government shutdown is resolved, the money flow goes more into IWM than into the Qs. And given that the Qs today are the strongest performer, up 0.6%, while IWM is flat, Dow Jones is flat, and S&Ps are only up about 0.25%, this is a spot where I really look at a calendar. And in particular, I'll show you the calendar I'm looking at here. It's the February 9th versus the February 2nd. You can see the February 9th vol is about 0.75% lower than February 2nd, while January 26th is a little bit lower than February 2nd. And the reason I like this kind of calendar is because traditionally this goes into a normal curve where February 9th vol should stay higher than February 2nd. I think the government shutdown resolution should help put some sellers into the front end of the curve. Slowing down this move that's already up 0.5% today should help put some slowing into the front of the curve, and that puts this calendar into a good spot here. At 42 cents, I think it's a pretty good R&R, knowing that my expectation here is that we grind a little bit higher. 160, it's a good stopping point. And throughout this week, if we just kind of grind higher, this calendar should appreciate in value some, and then I can reevaluate next week or midweek this week if the market moves a little too fast. But I know I'm only risking the 42 cents that I'd be getting in here. So that's my first trade that I'm going to be looking at today, is more of a calendar type position in the Qs. Second, when I look at IWM, the thing I want to note here is where volatility is relative to the other sectors. So IWM vol is kind of in the middle. It's 13% efficient. It can go up to about 16 and down to about 11.5, maybe 12, with a really bad vol level down to about 10. I don't see that coming up again for a little while here, though, especially with where vol is in SPY near the highs of the range and Qs near the highs of the range. So if IWM is cheap relative to the others, then this is the spot where I want to be long outright options potentially. Now, I do have a small diagonal on here where I'm short some January 26th options, given where we are right there. I don't mind that. But what I'm looking for in terms of an outright long right now is into February 9th. So this is part of my diagonal, but I'll be looking today at adding some upside here. 12.65% is not that expensive in IWM right now. So these 30 delta calls, the Feb 9th 161s for 88 cents, those look pretty good to me. Again, we can see on the chart here, the 12.65% is really not that expensive. It's not particularly cheap, but it's not bad here. And if IWM is going to play that catch up, then these 161s could actually be in the money pretty quickly. If QQQ versus IWM narrows down to, say, $5, and the Qs go to 168, that puts IWM at 163. So that's just something for me to have in mind. I'm looking for some more leverage in the February 9th term here. Now let's move over to TLT. Last week, I talked about how these lower lows and lower highs in the chopping action looked like this was getting set up for another leg lower. And I'm thinking that we're going to break through this level at 122. Really, 122.42, I guess, was the low here. I think that that's not going to hold this time. For us to create that lower low, I'm looking for a move down towards 121.5. What would negate that thesis is if the market rallied basically above this day's high, which is 124.27, then I'd be looking for a move back up here around 125 before the next leg lower. But for me right now, I can still see that next leg lower. We may be getting ready for the bump. A lot of times we kind of leave it at the low here. So we may be repeating this kind of pattern, this kind of pattern, this kind of pattern. But for me, if the government shutdown gets resolved, I think this is going to push TLT lower, yields back a little higher, and that puts TLT down towards 121.5. That's why I actually have some put spreads on, some 122.5, 121.5 put spreads. That targets the 121.5 strike. I'm not going to go into a lot of detail on that right now. That I'll focus on more in the premium Harwood Report newsletter that'll be out in a couple of hours. Dollar yen is really testing this 10-day moving average over and over. You can see that it pressed against it there, and even today. And the 10-day moving average is getting pretty steep here. So for us to see that continuation move in gold, dollar has to get a lot weaker, a lot faster. So it has to really get here below that day's low, 110.19. Otherwise, I'm looking for this to start creating that bounce back up towards 113 or 114 even, and create a bearish scenario for gold. So for gold, that would put us down to 122. It's simple as that. Vols come bouncing around. Again, I'll talk about the gold stuff more in the newsletter because I want to limit my amount of time I'm talking to you guys here, and I want to talk a little bit about an oil idea. But for me, and also because the dollar yen hasn't crossed the 10-day moving average yet. So once dollar yen crosses that 10-day moving average, I'm looking for all these interesting sort of bearish plays for a quick move down in gold. 122 is a good target for me there. In the miners, GDX, I'm looking down towards 22.5, maybe even lower. If this support level can't hold, we're looking down towards 21.25. GDXJ, I'm basically looking down here towards between 32 and 30. So, sort of that 31-ish range. It's all about whether this support can hold into that first break. So there's a lot of potential downside in the gold miners as well. And of course, silver. Silver is already playing around with a support range. So if this doesn't hold, I'm looking for it to go all the way down to 1480. That's a really big break in silver. Silver potentially has some more bearishness because there's less support below the market right now. It's trading at the prior sort of support and resistance level. A lot of volume traded here. If this doesn't hold, there's a lot of good downside there. There's a lot of really interesting ways for me to play that downside if and when dollar yen firms a little bit further. And I think the dollar yen will firm a little further if the TLT breaks. So I think that kind of goes hand in hand. I'm going to be watching both of those very carefully at the beginning of this week, again, because the government shutdown resolution could really get this move going. Now, finally, into the oil names. USO is still firm. It's playing around with the 10-day moving average right here, but this pullback has been bought so far. I still think there's that chance that we get the pullback to the 20-day moving average of 1242. That's not that far away, 30 cents, about 3%, 2 to 3%. It's not a huge pullback to then create some support to the oil names. And one thing I want to point out here is that XLE is higher today, and OIH is higher today. XLE and OIH are both back above the 10-day moving average, and part of the reason for that is that there's been some good oil earnings. OIH in particular looks ready to take off. It's pressing against the previous high here at 29.24. A move above there, I think, starts setting this up for a move into the 32 range. And it's not that hard to play that in options. So with OIH, you can see that this volatility is not cheap, but it's not expensive. 25% is a pretty good level. And if I can get anything around 23%, I'm getting cheap volatility. Well, if I look out to the February 23rd term, vol is up a little bit today. I can buy some stuff, maybe these February 30s for 24%, or these February 30.5s for 23.5% that play really well for a move to 32. So that's really where I'm going to be concentrating this week at the beginning, is looking for some ways to play some cheap options under 24% implied volatility on the upside for a move to 32. For now, my focus is going to be on these February 23rd 30.5 calls for 31 cents. Those look cheap to me, and they obviously provide a lot of leverage if oil firms and these oil companies that have started off with good earnings continue to have good earnings in the future. That's it for the charts for today, folks. I covered a lot of stuff on the free stuff here. I do cover a lot more in the premium product. So that's where I will talk through more of how I can play some of what's going on in S&Ps, even with volatility high, how I want to play all those gold and gold miner and silver names, and talk through a little more of like XLE and some of these other names that have some really good leverage trades. It's free for the first month. There's no real risk there. If you don't like it, cancel. If you do, it's $49 a month after that. I think it's a really good addition to a lot of people's weekly routine. I give another update in the middle of the week with this for subscribers. So if you enjoyed what you saw here, give the premium product a shot. It's free for that first month, so enjoy it. I hope you guys like the newsletter, and I hope you guys enjoy the videos. And we will talk, hopefully, to those of you that sign up later today, and again on Wednesday, and those that just choose not to, I'll see you again on Monday. You can always contact me. Keith at tradeacademy.co is the best way to get hold of me, or call me 312-600-8004. But again, email is usually the best. Thanks for listening. We'll talk soon. Bye-bye.